to this webinar that we are having today. Basically, uh, thanks for joining us on this webinar. While we live through this COVID era, another storm is brewing. A credit default pandemic is likely to be unleashed on the business world. And like doctors in the front line, we have with us today Suresh, who has been on the front line designing and helping clients fight the battle on credit risk. I will request Rahul Thakkar to give an introduction of Suresh, and then without wasting any further time, handing over to Rahul and then to Suresh. Rahul bhai, please. Rahul, you need to unmute, please.
Yeah, thank you, Manish bhai. It's a pleasure for me to introduce Suresh Khairwar to the participants of this webinar. Mr. Khairwar is the founder of Intel Risk Consultants, which represents the highest trade credit insurance expertise in India. IRC owes its worldwide presence to its holding company, the ICBA, the International Credit Brokers Alliance, which operates in 60 locations worldwide through 530 plus partners. Okay, and each of these partners have very deep understanding and expertise of trade credit insurance worldwide in their respective countries. Just to give you some more background about Suresh, I mean, he's been the country head, okay, of Euler Hermes. Okay, before Euler Hermes, he was with GIC Re and set up the credit insurance division there. Suresh also drove the business for Euler Hermes in India and was responsible for taking Euler Hermes to the #1 position here. He's also been instrumental in setting up, the credit insurance division of one of the private sector insurance companies in India. He was also appointed as a consultant by the Ministry of Commerce and by the GJEPC, the Gems and Jewelry Promotion Council. He ended up actually introducing a new product, okay, an industry-specific product in the Indian markets through ECGC. So, this is a short, brief introduction of Suresh. I'm handing it over to Suresh to take it forward.
Thank you, Rahul, for a nice introduction. Thank you, Manish bhai. Thank you, Subbu. Thank you, Greenback, for having us here today to talk about trade credit insurance. Thank you all the participants for joining in and such a time and through their homes. We're all trying to get adjusted to the these kind of situations where. But thank you very much for all your participants to join us. So let's start with the small introduction, of the trade credit insurance, the product which you're talking about. We'll move on to the next. We have made some slides to introduce the products, and then we will have the question and answers later on for all the participants to have a one-to-one or meaningful interactions. After the presentation, please note down the questions during the presentation, and please ask all the questions either through WhatsApp or quick Q&A in the Zoom, or through email. Email probably may not be able to reply quickly, but WhatsApp and Q&A will be able to reply much quicker than anything else. So let's talk about the trade credit insurance, what exactly the product is. This is basically, Rahul, can we go to, yeah. So this is basically the insurance, one of the insurance product. And this insurance kicks in, let's say, to cover any kind of a potential non-payment by the buyer. So it's basically a policy, insurance policy, which protects a seller from a potential non-payment by the buyer to whom the goods or services supplied on credit terms. So that's the basic introduction of trade credit insurance as an insurance policy. The kind of risk which we cover under trade credit insurance is basically insolvency. When the buyer goes bankrupt, which means the buyer is willing to pay but has no ability to pay. Then the next risk is covered, which is protracted default. It's called willful default. In these kind of situation where buyer is having the money but he has no willingness to pay, those kind of circumstances also covered under trade credit insurance. And third risk which is covered is basically into the for export market, export transaction. And if somebody is exporting from India, we can also cover them against the risk of country related default issues, like if the country action, any political action which prevents the transfer of money from one country to another, any kind of convertibility issues, or any kind of embargo or sanctions, or those kind of political motivated issues are covered under trade credit insurance policy. Next, Rahul. Yeah. The type of transaction which are covered, like we cover only, the policy can cover only trade receivables. Any kind of loan receivables are excluded from the purview of this policy. It is covering only business to business transactions, not covering the business to retail or the individual customer transaction. This policy covers domestic geographies and export geographies both, and it's applicable to goods and services sales. This policy are generally for a short-term credits ranging from, let's say, 30 days to 180 days. And this policy can cover or extend the coverage of the policy to pre-shipment risk as well. But predominantly, the policy is aimed is kind of designed to cover the post-shipment risk of a seller. What is not covered is basically on a buyer side, if any of the buyers are overdue for more than 60 days at the beginning of the policy or at the beginning of the risk, then probably this is not covered. And if there is a buyer which is insolvent prior to dispatch, that's not covered. Any private individual is not covered, and the government department, sale to any government department is not covered. Then you have on the seller side, if seller do not fulfill their contractual obligations, then the policy doesn't really kick in. If the seller goes insolvent, then the policy ceases to exist. And if the seller has any prior knowledge of the adverse information of the buyer, and still continues to sell to that particular buyer, then again, the policy does not cover such circumstances. On the invoice level, if all those invoices which are issued prior to the insurance policy are not covered. So whenever the insurance starts and afterwards, whatever invoices are raised on the particular buyer are covered. Overdues, anyways, any invoices which is remaining overdue for more than, let's say, 90 days from the original credit terms are not covered. Any invoices which are like disputed because of any non-fulfillment of commitment or late dispatches or all that stuff, quality, quantity, price, all those disputed invoices are kept outside the purview of trade credit insurance. Any interest and penalties levied on the non-payment are also excluded. So when we talk about domestic sales, this policy covers both domestic and export. So when we talk about domestic sales, this policy, trade credit insurance policy, is very, very helpful in protecting the balance sheet from the bad debts. All the receivables which go bad and sit in the balance sheet as a bad debts and drag on the balance sheet are knocked off, because the trade credit insurance policies will compensate the client on these kind of a bad debt. So the policy really protects the balance sheet from a bad debt. This policy helps in increasing the sales. So the sales can really, the seller can look into different markets, different territories, and different countries to increase the sales. And this product is very, very effective in those circumstances. Complete receivable Rahul, can you go back? I'm sorry. increase in sales, a complete receivable management solution by experts. So especially mid and large segments, if they do not have the proper receivable management systems in place, then they just can't. They just can buy the policy, and the policy will have all the systems in place for a very effective receivable management done by experts. So the buyer information is sourced by expert. The limit are managed by the experts, and the recoveries are also done by top of the line legal systems. So a particular seller who buys this trade credit insurance policy gets automatic access to a complete receivable management solution managed by the experts, best experts in the business. Legal cost reimbursements in a local market, if you sell and then you have to really put up a legal case to recover those kind of amount, all the legal costs will also be reimbursed by this policy. This policy can also be assigned to the banks so that your ratings can improve, you can get better working capital facilities, and it can help in additional financing. So apart from working capital financing, there are some structures where clients can the clients can access to from Kailash Varodia, Mr. Varodia. I will take the questions after the presentation is done, but just to quickly answer, IID allows the assignment to the bank with the from the recent circular. So anyway, we'll discuss later on in more details if it's required, but let's move on here right now. So additional financing can be that there can be some structures where the NBFCs can finance the receivables, and it can be sale of receivable off balance sheet. So it will not be eating away the working capital limit, and it can really help in sourcing additional financing for the corporates in domestic market. When we talk about the export sales, it definitely covers again political risk of other countries like confiscation, expropriation, nationalization, currency inconvertibility, political violence, contract frustration, sovereign defaults, wrongful calling of bonds. Then it also can extend to pre-shipment and post-shipment covers, in the sense that at the time you are doing the the preparation to sell, the ECAs of the world, and in our country the ECA is ECGC. ECGC provides packing credit facility for the pre-shipments, and then that gets converted into post-shipment financing as soon as the shipment is done to the particular buyer. And this can also help in without recourse financing. So without collateral and without recourse financing of the export sales. There are various options for without recourse and without collateral financing available for export sales. So when we discussed about the product, what it can do and what it does not cover, and we would like to highlight our study on the current situation where we all see that the companies are stressed, everybody is asking for longer credit terms, and there are very eminent and visible default situation in the market. So what we like to give you the update from our side, our research, is that all the sellers from India should be prepared for things to come in this year and at least the first half of the next year. So we see the increase in global insolvencies by 15%. So let's say the year before, the global insolvencies were roughly about 13% of all the sales, and then last year was 9%. But again, this year it is going to be increased by 15%. Definitely, we're already witnessing the demand shock from China. China halted production, and still there are less movements of the goods, and there are a lot of uncertainties from the Chinese market. So definitely the sectors like automobile, electronics, non-food retail, chemical, and pharmaceutical sectors will still continue to see some demand shocks from their imports of raw materials. A high level of uncertainty in Q4 of 2020 due to possibility of second wave. There are talks of second waves if this COVID-19 is not contained. or there's sometimes reports saying that the gene is mutating. So we cannot rule out the second wave. And if the second wave comes, probably we see a kind of a L-shaped recovery instead of a U-shape, which we see if the second wave doesn't come in. So if the second wave doesn't come in and we really contain this kind of a virus, then probably the demand bounce back would be really decent. And Q2 to Q3 in 2021, we see a sharp increase in the business activity and GDP. But if the possible second wave comes in, then probably recovery will be delayed and lagged, and there are many other problems to address if that happens. And uncertainty due to the US elections and Brexit definitely poses a lot of manufacturing companies and traders to really go cautious on their business. We see liquidity stress in present, and it is also continuing, likely to continue for the rest of the year and the first quarter of 2021. Although a lot of governments are pumping in money and trying to help in the businesses by providing some kind of a liquidity assistance and some kind of a trade finance guarantees and stuff like that. But we believe, as per the figure, we see that these are likely to be falling short, and the liquidity stress is likely to continue. Definitely spreads in the corporate bond and sovereign bonds are going to be increasing. So that will put a lot of stress on working capital financing from both the sides. A mid-year changes extension in the contract terms. That's what we see. A lot of companies who have placed an order earlier are definitely going to come and ask for some changes, if not all of them, but some changes definitely are foreseeable. And so all the sellers and exporter have to be really prepared for the time when the buyers came knocking and asking for extension or changes in the contract term. Post Q1 2021, we see kind of a spurt in inquiries and demand from India in specific segments. But in general, we will see the spurt in demand and consumer spending in it's kind of a late Q1 of 2021 or maybe mid Q1 2021. These are assumptions in the post-COVID situation, and these are the points to be considered while we prepare ourselves or businesses to face situations post-COVID-19. So we see during these times there are essentials to really incorporate in the ongoing business. Is that speed in selection of the new buyer. When the inquiry starts coming in, we need to have systems in place which will allow us to select the right kind of a buyer in the minimum time span. Carefully worded and structured contracts. So, there are various types of contracts, and the contracts which were like historically and in earlier times, they were in practice and they were continued. Probably there are a few changes which will be required in the contracts going forward. And that's why the contract has to be carefully worded going forward post-COVID situation. It will be a great demand for off-balance sheet financing, sale of receivables, because the working capital limits and financing in general is going to be stressed. Definitely strong working capital management is the ask, and effective recovery mechanism. We have not seen these kind of unprecedented situation where the one black swan event hit the global economy at the singular point in time. And that has resulted into non-payment or delayed in payment coming out of virtually all the places, domestic and outside. So if you don't have the effective recovery mechanism for domestic and outside, it'll be a lot of time and money and effort spent on trying to figure out how to deal with such kind of a situation. So going forward, a very, very effective and robust recovery mechanism system has to be in place for all the businesses. Economy, trade, and buyer information availability. So the information availability becomes very, very crucial going forward, that how the economies are reacting to such kind of a lockdown or slowdown. We would see that in Europe, a lot of SMEs will vanish virtually. There'll be there are a specific segment even now which is called a zombie SME segment, which is likely to really turn bad or might recover. Nobody knows the fate. So the information will unfold going forward, and sometimes the flow of information has to be or will be erratic. So if the companies are not really in control of the right information and the correct information at the right time, they might likely to take some wrong decisions and risk their balance sheets. So information availability is very, very vital, and de-risking of the balance sheet and the business continuation plan has to be very, very important going forward. So we highlighted these points where we think that these are going to be things to talk about in the future, where we as a corporation can contribute and really introduce best practices to a lot of corporates in the country. Our expertise, our research comes from our reach in 60 countries across the globe. We have trade credit insurance experts sitting all across the countries. All our partners have been trade credit insurance underwriter for more than 20 years in that specific country. So we are in a decent position to assimilate all the information on a very, very regular basis, and we'll keep on imparting these on a time basis. Rahul? So I think the best way to now go forward with the presentation is that I can see that the question and answer anyways started coming in. So we will start to take it, but before that, we'll just touch upon the forthcoming webinars and trade rating in the COVID-19 era, trade finance opportunities, and hedged accounting in light of COVID-19. That we'll come up with those seminars in time to come. But for now, let's concentrate on trade credit insurance, and we'll be more than happy to take any questions now. I think there are questions.
So there's a question from Ketan Gaikwad, which does ask trade credit insurance, which was primarily prior to the ADA ban in 2010, is not there in India. Like you're opening up the trade credit insurance for domestic banks. He's basically asking whether trade credit insurance is going to be opening up for domestic banks anytime in the future, since it was banned in 2010.
Yeah. So Ketan, good question. There's already a discussion going on with IRDA. There was some panel created with the industry participants, and they have made the recommendations. And most likely, what we hear from IRDA, what we hear from other participants in the market, what we hear from the committee members who participated there, I think the mood is very positive, and looks like the restrictions will be relaxed very soon. So I'll take Vasudevan's question. Is there any minimum criteria for taking the insurance? So Vasudevan, there are obviously turnover constraints. So if the business turnover is very small, probably the trade credit insurance may not be available. So the turnover has to be, let's say, about 20-25 crores plus for this to make so credit insurance to be available. So there is some minimum criteria. If you're not from restricted industries like gold trading, gems and jewelry, for gems and jewelry, there is a specific product with ECGC. Otherwise, in the domestic market, it's difficult, virtually not available. And for steel trading, coal trading, commodities, that will be difficult. Otherwise, there is only turnover criteria, and your credit terms should not be more than 180 days. If you're working with a buyer on extended credit terms or longer credit terms than 180 days, still can be structured, but it's difficult. And in these times where the capacity is constrained, it is all the more difficult to source. But if your turnover is more than 20, 25 crores, your credit terms are 30, 60, 90, up to 180. If you are any other segment than gems and jewelry and gold trading, definitely you can get this product.
So next question is, do we also get cover for work in process of export orders if the buyer cancels the order later?
Yes, Muralidharanji, we can get the special endorsement in the policy, and this can be covered. So there has to be a binding contract, and there's to be a product which is specific to the client's requirement and specification. If you're preparing those kind of goods, and during the process of completing a production, if the buyer goes insolvent, the cover triggers and you'll get your payment.
What happens with letter of credit, and how is this related to the trade credit insurance?
So these are letter of credit, trade credit insurance, and there are various different to trade in foreign countries. The letter of credit actually makes the bank responsible to make the payment. Bank takes the guarantee of payments, and thereby the risk from the buyer's default is passed on to the banks. So that makes the structure more safe to deal with. But bank letter of credit is relatively expensive, and it is one transaction. It doesn't really involve any other thing. Whereas a trade credit insurance really pushes you to sell on open terms. And if you're selling on open credit, trade credit insurance comes up as a part of your own organization and supports you with a lot of information like what is the buyer, what should be the right level of limit to deal with this buyer. And while you're dealing with this buyer, any negative information comes in, the insurance companies pass on to you, and also insurance company help in the recovery. So if you're dealing with a foreign buyer, let's say in the US, and if it doesn't pay, the cost of recovery, the cost of legal is too high. Trade credit insurance can compensate the cost of recovery also, and at the end, it compensates the seller if at all the buyer defaults. So trade credit insurance is a kind of a larger product which involves everything at a much reasonable cost. It's not just one-off transaction on LC.
Yeah.
Yeah, go ahead.
Are there options of a single buyer policy available, or is it only for the whole turnover?
Right now, the trade credit insurance in domestic market is only available for whole turnover policy, whole turnover structures. For export transaction, we still can have single buyer policies.
What would be the cost of credit insurance?
The cost of credit insurance can be, it's not the generally the off-the-shelf product. Apart from ECGC generally is off-the-shelf product. The pricing is known to everybody. You can refer the pricing. But if you're selling in domestic market, it's a structured product. Generally, it is the price is arrived after taking your information in terms of bad debts, the turnover, the number of buyers, and credit terms, and industry segment, past loss experience. Everything put together gives the pricing. But the pricing can be ballpark. Let's say for a whole turnover of 100 crores, the pricing can be roughly 20 basis points, 0.20%, something like that.
Who are the insurance providers available in India? I mean, this is a question specifically from the Palava group.
Yeah. So in domestic market, we have New India, HDFC, ICICI, AIG, Future Generali. These are the insurance companies who are available to give you trade credit insurance.
There's a question from Mr. Muralidharan. Is ECGC not able to provide sufficient credit limits? Are private players able to supplement or grant independent limits?
Yes, Mr. Muralidharan. Private sectors generally have can have a larger appetite on specific buyers. If especially if the buyer is well known, then the private sector can definitely provide much larger limits. Only thing is that the private players may not be able to come on the top. So you cannot have partial limit by ECGC and the partial limit by private sector. You can go to one of the private sector insurance companies. If ECGC is falling short on the limits, then the private sector will assume the entire limits. The only catch here is that with the ECGC, you can go with a single buyer and on that specific limit. But as soon as you come to private sector, you have to offer your whole turnover. So the buyer in question can definitely have a larger limits. I mean, depending upon, not definitely, but can have a larger limit depending upon their standing in the market and all the rest of the factors which trade credit insurance companies take into account. But you have to offer the whole turnover, wherein they would give you the limit in question on the buyer in question and for the rest of the portfolio as well.
There's a question from Kailash Barodia. Are there any negative industries or segments currently that the insurers see?
Yes, definitely. Gems and jewelry is a negative segment. Coal trading, as I said, steel trading is negative right now. Construction segment is negative. You have the color stones, gems. You have, yeah, I think that is predominantly the exclusions.
Another question from Palava Group. Are there any alternatives for export receivables to an ECDC?
Yes, sir. So all the insurance companies which I mentioned just now, New India, AIG, HDFC, ICICI, all of them offer alternatives to ECGC. So they can do domestic as well as the export coverage.
Can I also ask you, because I see a couple of questions from multiple people, okay, still wanting to know whether it's going to be a whole turnover policy or is it going to be buyer specific? So can you again explain this in perspective as to what options are available in the market?
Sure. So we can divide into two parts. One is the domestic market. So if a seller is selling into domestic market and approaches the insurance company for cover against the domestic by default, then necessarily it has to be a whole turnover structure. They have to offer the whole turnover to the insurance company. Anti-selection is not allowed. Insurance company might choose which buyer to cover, which buyer to exclude. And their selection is purely based on adverse information. So we can safely assume that if there are no negative information on the buyer, then definitely they are going to get the cover. So in the domestic market, you have to offer the whole turnover. The selection of the buyer is not possible. But we take the second part as export. In export, all the possible combinations are available, like single shipment, single buyer, single buyer, continuous shipment, or multiple buyer, or whole turnover. Everything is possible for foreign export transactions.
Are there any country-wise caps, etc., when you basically apply for limits?
There are country-wise exposure limits with each underwriter, and it is different between different underwriter depending upon their past experience and outlook on these particular countries. But yes, every underwriter has their specific countries' exposure limits.
Is there any specific rating requirement if you want to seek limits, okay, on a buyer who you're going to cover as a part of your domestic credit insurance program?
No, sir. In fact, there are limits available right now, even on non-private limited companies as well, proprietaries, partnerships. All those companies can also get limits from private sector underwriters. So as long as some information is available, preferably financial information through personal sources or open sources, or the trading experience is available, or some market information is available, the limit can be given on a buyer. It's definitely not needed to be rated company.
The DCL, is there a difference in the DCL by the private sector? Is it lower compared to that provided by ECGC?
A discretionary credit limit. So the ECGC, for the sake of simplicity, works in a very simple structure, wherein they define everything in advance and you take it. It's an off-the-shelf product. You take it, whereas everything is defined. The DCL is defined, all the parameters in the policy, pricing, everything is defined. But when you come to private sector, everything is structured. So depending upon your exposure to the buyer, your peak outstanding at any point in time, your number of buyers, and your experience in the past, it all defines the DCL. So there cannot be a standard answer whether DCL is lower or higher when the private sector comes into play. But DCL is definitely structured. It can be very, very high when it comes to private sector. Sometimes DCL can be you know, clubbed together with the first loss concept where you take a first loss hit and then you can enjoy a very, very large discretionary credit limit. So it's completely different from buyer to, the policyholder to policyholder when it comes to private sector.
Is the limit of liability under MBEP higher than what is offered by the private players? This is a question from Sanjeev Patra.
Yeah. So limit of liability again is structured, but uh, you can say that private sector. So I mean, again, so ECGC has a very standard way of offering a limit of liability. So you have a turnover, 10% of that is the overall liability, and then 10% that is per buyer liability. So that's kind of a definition there. Where in the private sector, you come in and that they start with, let's say, because the historical actuarial data tells you that you know, you have a peak exposure. So the limit of liability is designed based on how much your top 2 or 3 buyer exposures are and how much premium you're paying. So the generally the benchmark or the simple yardstick of the limit of liability is, let's say, 20, 30 times of the premium paid. So we start from this level in the private sector. So it can be higher, it can be lower from MBP. As I explained, that MBP is decided based on what is the exposure level you take. So turnover 10%, 10%. So whereas the private sector designs the MLL depending upon your peak exposures and how much premium you're expected to pay, how much is the risk on loss, the buyer exposure on risk. And then, as I said, that basic yardstick is 20, 30 to 40 times the premium paid. So it can be higher than ECGC in some cases.
Okay, I'm taking one question which has come from the YouTube. Okay, you know, you've spoken about effective recovery mechanisms. Can you give an example of this for SMEs and how can SMEs implement the same?
Yeah, so effective recovery mechanism is basically when we say, so there are two parts of the whole thing. One is that if you, let's say, buy this insurance, trade credit insurance. Now, trade credit insurance is managed by people who have been in this business for a long, long time. The product is introduced in India roughly in 2005-6, and companies have been in the business. They have seen how the Indian buyers behave, and they have outsourced the recoveries sometimes to some of the legal agencies. They've been with the insurance companies for a long time. So they've seen the buyers, they've filed the legal cases, they won the cases. So if you buy this trade credit insurance, you automatically get the facility uh, or the expertise created by these trade credit insurance dealing with Indian buyers for a long time. So that is one effective recovery mechanism wherein you don't have to really think about different situations, what to do, what not to do. You just rely on trade credit insurance companies. They will guide you through. They will also take care of your legal expenses and pay you at the end if there is no recovery. Apart from that, the second aspect of it is basically you have a third party agencies where you can go and, or you can impanel them with you. And whenever there's a buyer who is in distress, you can start using them. But finally, I would say the best recovery mechanism is the self-discipline. So when we advise our clients, we always advise that the sooner you start recovery proceedings, the better your chances are to recover. So internally, you have to have some kind of a best practices involved, and then you have to behave in such a way all the time. The business has to be separated from individuals or emotion-driven decisions, and these are the best practices which will help you in recovery of your bad debts or past due amounts.
Suresh, can you take us through, how does the insurance work right from inception to the
Right.
last compliance and the claims? I mean, there's a question specifically from Yogesh on this.
Perfect, perfect. So we have not covered it in our presentation. So I'll just briefly take everybody through how the product works. So when you buy the policy in the first day, obviously the structures are done, the pricing is done, everything. The first day the policy starts, you give all the buyers to trade credit insurance company. For example, if you have 100 buyers which you're dealing with existing, you give it to trade credit insurance company. They will reanalyze all the buyers with their financials, the market information, and everything else, and then they will reset the limits for you, for all the buyers. There's a possibility that the insurance company might come back and say, don't deal with this buyer. There are some bad information or negative news in the market. Or they might come back and say, deal with this buyer, whatever amount you like to deal with. So that is the first step. The buyer limit is set. And then on a month-on-month basis, the AR account receivable are analyzed. So insurance company will take information from you. Every insurance company has a different periodicity. Sometimes they take monthly, sometimes they quarterly. So they will take all the review of your buyers. Let's say for example monthly. Let's keep the periodicity as monthly. Um, so on a month-on-month basis, the account receivables are analyzed that in terms of aging. So how many buyers are there in 30 days, 60 days, 90 days bucket? How many buyers are going over 30 days, 90 days bucket? And then accordingly, insurance companies would start to consult the policy holder that what to do in these kind of a situation. And if the overdue goes beyond, let's say, so there are 30 days to 60 days given for the seller to still keep on supplying to that particular buyer if he's going out of the overdue buckets. If even even within those period the buyer doesn't pay, then the insurance company would ask the client to make a claim, or the clients can make a claim on themselves, and then insurance company will start the recovery process by deploying some lawyers mutually together or their own. Some insurance company take the entire collection efforts on themselves, and we start the collection process, the communication with the buyer. At the end of so this whole process goes for 6 months in case of the willful default. In case the buyer goes insolvent, which is known insolvency, after the admission of the claim, 30 days is the processing time, you get the money. If the buyer, let's say, is kind of not behaving, or if it's willfully not paying, then the whole process might take about 6 months. After the 6 months cutoff period, the insurance company will pay the claim and then take care of the recoveries of the buyer. So this is a kind of a whole cycle from start to claims payment, in brief.
There is a question from Vibhor Beriwala. They are into manufacturing of cotton yarns, and basically they would like to take credit insurance. Who do they reach out to?
Okay. So you have an email in this on the screen right now. You can send your email, a request on this email, and we'll reply back. We'll take it up from there.
Um, if there are sales being done on, I mean, they're backed by LC, is there a requirement for trade credit insurance?
Yes. So let's say there are in export transaction, there are some LCs issued by some lesser known bank. Then definitely it really poses the risk of default by the bank. So even in some cases where LCs are issued, LCs are available, there is a risk, and trade credit insurance can definitely help there in terms of providing cover if the banker, those kind of a banker fails, that specific banker fails to honor the commitment, the insurance company can pay the claim. So in certain circumstances, definitely, even if there is an LC, the cover can be really helpful. ECGC has a standard process of offering the choice. So ECGC can also give you standard choice of covering all the shipments, even if it is done through LC. But from the questions perspective, whether there is a requirement or not, I would say in those cases where the LCs are issued by a lesser known bank and they're not confirmed by a higher rated bank, we definitely see there is a requirement of making it more secured by trade credit insurance.
Uh, I mean, in terms of a claim, okay, what is the documentation required or process to be complied with and followed?
In times of claims, the basic, very, I will touch upon only very basic requirements of the document, which are very, very vital. So if you have a couple of basic documents in place, there won't be any problems in the claims. So first thing is that we need to establish the liability of a buyer to pay. So if there are, let's say, the lorry receipts or delivery receipt or bill of lading, which really establishes the fact that the goods have been delivered, and now the buyer is liable to pay because he has taken the possession of the goods. Obviously, this is followed by the, or let's say it is the effect of the sales contract, obviously. So I'm assuming that sales contract is rightly worded and it says the sales on credit and it defines the all do's and don'ts. When that happens, the first thing has to be that the liability has to establish. So you have to have the proof of delivery. That is a very, very important document. Once you have a proof of delivery, then you have to have the, obviously along with that, you have to have an invoice. Invoice is raised, sometimes invoice can be raised at the time of shipping or at the time of taking delivery. But invoices have to be in place and the lorry receipt or the bill of lading or proof of delivery has to be in place. These are the most important document. And then in the communication where whatever the buyer says about the payment, why he's not paying, reasons for non-payment. These are the main documents. If these are available, claims are usually through more than 90% times.
I'll just switch to a couple of questions from the YouTube. There's a question from Piyush Pandya. Are there any countries which are on the negative list as far as exports are concerned?
So again, negative list depends upon insurer to insurer. If I have to give you the broader outlook, then I would say ECGC has the largest coverage available right now in India. So when you look at ECGC coverages, then you can safely assume that the private sector would have lesser coverage than that. So, it depends upon, let's say, what is your exposure to risky countries vis-a-vis your overall exposure to rest of the countries. So if you only selling to difficult countries, then probably ACGC would provide the best coverage. But if you're supplying to European countries or US or some of the better rated companies, then definitely private sector can give you much larger coverage in terms of even smaller country, more information about those specific countries. But to give you a short answer, of course, all the insurance company would have their negative country list, and it differs from company to company.
There's one more from Pavan Kumar Mittal. Can new buyers be added to the policy during the policy period?
Yes, sir. So the policy is open policy. When you start the policy at the beginning, you give all the buyers, and then any time you come across any inquiry or any new buyers, you can keep on including it into the trade credit insurance program, and the premiums are adjusted accordingly. It's an open policy, so you can include the new buyers at any point in time during the currency of the policy.
Okay. There is one question which is more to do not only with plain insurance, but it also has the financial aspect. The question is, if it is a non-recourse, who pays the lawyer for who pays the lawyer's charges in case of a default?
If it's a non-recourse financing, then it's basically all the cost to the financiers. If the buyer doesn't, obviously the seller would get the money upfront, and if the buyer doesn't pay, The financer will bear all the expenses to recover the money from the buyer.
One more question from the WhatsApp. Is there a difference between the private players and ECGC, and what is the difference between the coverages?
Yeah, so uh, definitely there is a difference between private sector and ECGC because of the fact that ECGC is promoted or let's say established in India to promote the trade, promote the export. So their objective is to provide much wider coverage and ease of buying policies. So their approach is completely revolving around how fast you can get the policy and how best manner you can manage the policy with minimum of paperwork and how fast you can get the claim in time of difficulties. Uh, Private sector work on a slightly different methods. Private sector is more risk oriented approach. So it's more of a risk management or receivable management process which keep changing, which is very dynamic. So from time to time, the buyer, the sector, the country will keep changing, and then private sector aligns themselves according to those needs. So the private sector thought process is that you get driven by the experience and knowledge and recommendation by trade credit insurance companies. So they would give you upfront knowledge of country, the buyer, the segment, the kind of a recovery process, and everything else, so that you trust in them and then you grow the business. Wherein ECGC is a kind of a blanket where they don't change their risk perception too quickly. They don't change important aspects of the policy too quickly. So these are the differences in the terms of the thought processes. The differences in terms of operations are like in terms of buyer assessment, the private companies have a much wider network because they can do close to buyer underwriting. Let's say we talk about a couple of large private sector insurance company who have more than 125 to 150 offices across the globe. So they can give you the buyer's perspective through their offices sitting in that country, so close to buyer perspective. Whereas ECGC can give you a broader perspective. In terms of claims and recovery, ECGC generally relies on third-party services. So ECGC asks you to go to a third party, and third party would help you, assist you in recoveries, and then they kind of give their feedback to ECGC about what has happened. Whereas the private sector gets involved at the same time of a delay or default, and together they would try to assist client to recover the amount. And then third in the operation side, these are the structuring side. There can be various differences. The some of the conditions mentioned, like DCLs and MLL and stuff like that. So there can be various structures possible with the private sector, which are customized to the specific need of the client. Although ECGC also has some customization, obviously they do a lot of customization, but the private sector is uh, more let's say more customized than off the shelf, wherein the ECGC is more off the shelf than customized.
Uh, there's a question from Kailash Barodia. Can a particular seller buy multiple policies from different insurance companies on a particular buyer if he's falling short of limits?
So the multiple insurances are not allowed. Uh, in India, it's not allowed by law. Even in foreign countries, generally, insurance policies will have a clause that um, it's generally not allowed to buy insurances from other other players if there is already insurance available. It's because of the fact that each insurance company has a very good sufficient capacity to give limits. If they do not give limits, there has to be a reason, and the reason is the negative information. So the private insurance companies would like to believe that you are giving a lot of importance to the negative information and abiding by restricting your sales within the limits given by the private insurance companies. So that is why principally it is not a kind of a practice which is allowed to have multiple limits by multiple insurance companies. Generally, that's kind of a negative factor in the policy. There can be some structures possible where are the top-up structures or additional capacity. If let's say capacity requirement is too large, those are specifically syndicated programs. Those are really very, very far few in between, and those are like more multinational programs where capacities of let's say 500, 600 crores on a buyer, and then you have to have layers of different insurance companies covering at a different exposure levels. But on a small, when I say small, I mean to say, let's say up to 100 crores, or let's say up to 80 to 100 crores limit, uh, the specific insurance company can absorb the limit, and it is not advisable to go with a multiple insurance company. That's a negative thing in the policy. Probably the claim can be rejected because of the reason. If there's a specific clause in the insurance policy which prohibits using multiple insurance, if the client uses multiple insurance, that can be claims can be rejected. And definitely in India, in a domestic segment, this is a negative thing because it's not allowed as well.
Question from Mayank Goenka. What happens if majority of the buyers are defaulters, okay, as stated by the insurance company, and the company asks you not to do any further trade with such buyers?
Yeah, so that's what I mentioned a while ago, that the trade credit insurance companies come with a particular policy holder as a one unit or one setup, or let's say extension of the policy holder itself. And insurance company would like to believe that since they are into business for a long time and they understand the default, they can understand the indication of defaults, and they have a preview of a lot of information in the market. So they would like the policyholder to abide by their recommendation. So if there are a lot of defaulters in the portfolio, and the insurance company reduces or cancels the limit, if at all the policyholder still feels that they would like to do business with them, they can do the business with them. The policy doesn't get cancelled. The only thing is that the policy will not pay for those buyers which are negative, or which are termed as defaulter, or which have no limits under the policy. But you can still continue dealing with the buyer of the policy. There is no negative implication of the policy. Once the limit is cancelled, you are on your own. You can do whatever you want with the buyer, and the policy does not have any effect on that.
The next question is from Ketan Gaikwad. What is your view on the recent IRDA approval obtained by an Indian insurance firm for sandbox testing of trade credit insurance on TRED's platform? It was primarily to do with domestic non-recourse factoring for MSMEs,
Right.
receivables against suppliers to corporates.
Correct. Yeah. So the platforms, definitely, it's a very good move, a very, very welcome move. A lot of platforms are looking for such kind of a solution, but right now it's only available for, let's say, trades. Um, but the only there can be multiple issues which we need to, or the underwriters need to deal with before they would come up with a policy. Because right now the platforms are not really guaranteeing any settlements. If they're not guaranteeing any settlements, they do not really have the risk and no insurable interest. If they have no risk and no insurable interest, they cannot buy the policy. So there has to be a kind of a guarantee built in somehow in the whole thing for the insurable interest to be there on such kind of a platform transaction. And even if we cross that bridge, there'll be still some questions, like there'll be still single invoices, single buyers. And if that buyer is defaulted to somebody else and puts in their invoices on TREDS, and some banks takes it, and there's a policy which is a blanket policy, then there can be a conflict. So, and then there'll be reportings. Who will do the reporting? What kind of a reporting? How the insurance company will be in control of all the receivables and aging at all point in time? So these are the challenges. Uh, but the move is definitely very, very welcome move, much needed. But if we can cross this bridge of this uh, important questions, and then probably it is a wonderful. I'm sure we'll be able to do that at some point in time. The underwriters and the platforms will come together and address all the questions. But definitely, it is the future, and it is a very, very big boost for SME MME segment in India.
Uh, I'll take a couple of questions from the YouTube again. There's a question from Hitesh Bhatia. Have uh, have the major players tried to move paperless? I mean, in terms of processes and the uses of blockchain, is it happening? Okay, and what is your view on the use of blockchain and trade credit insurance?
Yeah, blockchain is a very, very good technology. All the contracts can be written in blockchain, and this is really providing a much, much robust chain of all the contracts written in the past sales contract and the obligations and everything. And it is very difficult to then pose kind of a dispute at the later stage if the contracts and everything are on blockchain. It is a must, and definitely this technology will be used extensively by trade credit insurance underwriters. Euler Hermes is one of the underwriters who already started working on this. They were the first ones, and they have some of the I think some of the structures available. But it will take some time for this to be implemented in India or to be used by India. But yes, definitely it is very conducive for trade credit insurance because it brings more clarity to the whole contract and makes the claim payable much more easier. If the liability can be established very faster, the faster it establishes, the faster insurance company can pay the claim. So it's very, very good, it's very, very strong technology, and underwriters are really working on it already. Euler has done something, and this is definitely again the thing of future, and it will definitely come at some point in time in the Indian market as well.
There's one more from Hitesh Pimpalchende. If they opt for trade credit insurance, will their buyers know about this?
So the objective of trade credit insurance is that your buyer should not be aware that you have the insurance policy against them. If it happens, generally, I mean, purely by the experience, no judgmental statement here, but purely by the experience, this gives rise to some kind of a moral hazard in Indian market specifically. When the buyer know that they are covered, they probably tend to delay the payment and tend to kind of negotiate hard with the seller on the non-payment. So generally, the ideal situation is that the buyer should not be aware that the seller has taken insurance on them. Then the credit insurance policy works very, very effectively.
Question from Kailash Barodia. Is it possible to have insurance, okay, taken on newer buyers, or is it necessarily available only on existing buyers of theirs?
So new buyers definitely on a continuation basis. Even if let's say you buy the policy today, and if you have existing buyers, let's say 10 existing buyers, and you have a couple of inquiries, you can put together all 12 to insurance companies, and insurance companies can give upfront limit on all the 12 buyers. So to start with the policy, you can still give all the existing and the new buyer to insurance companies, and going forward ongoing basis in the policy, you can always have a cover on a new buyer. So it is not necessarily that your cover stop with the existing set of buyer. This policy actually is designed to give you kind of a dynamic buyer portfolio. So if you keep, let's say, taking out all the buyers who are not paying on time and keep including new buyer with the help of trade credit insurance by asking for a limit, and if the insurance company gives the limit, you start selling. So over the period of a few years, your portfolio will become much, much stronger, where the inclusion of new and strong buyers will outshine the buyers which are not paying and the bad kind of a delayed payment buyers. So your portfolio gets much, much stronger over the period with the help of trade insurance.
Is the trade credit insurance policy transferable, or can it be hypothetical?
The trade credit insurance policy is non-transferable, and it cannot be hypothecated, but it can be assigned to the bank as per recent regulations, but it's not transferable.
Uh, if the trade terms are FOB and the goods are at a port, okay, and they're damaged, whose responsibility will this be?
So in a FOB, definitely the insurance responsibility is on the buyer, but you need to see this Incoterms together with the terms of contract. So when you look at the terms of the contract, sales contract, and if it says that it is the buyer's responsibility to give the goods in a specific quality and quantity at the buyer's port, and the delivery of the goods is considered to be at the port. Then if there are any damages happens, the responsibility will still be with the seller, because as per the sales contract or the purchase contract, it is violating those contracts. So we need to see Incoterms together with the sales contract and take a call whether the responsibility is, so if the responsibility of the seller ceases to exist and the goods are considered to be delivered FOB on the seller's port of shipment, then any damage happens is the responsibility of the seller.
Are there any special offerings available for MSMEs as far as TCI goes?
Unfortunately, no. We've been working very, very hard to introduce some of the products, but very, very unfortunate that there is nothing available. There are some scheme with ECGC, obviously, but those are like for small exporters, and for the domestic segment, there is nothing. It is actually on the contrary. So domestic trade credit insurance market is dominated by European players, and they would have their minimum thresholds as a reinsurance underwriter. So as I mentioned in the past, in the earlier times of conference, that the minimum threshold of turnover has to be some 20-25 crores for you to be able to buy the trade credit insurance policy. So very unfortunately that the MSME segment doesn't have any preference, rather than it has a more of a rejection at this point in time in the domestic market. We are definitely working hard. We have come up with a product in the past with one of the underwriters, but we could not find many of the buyers that time. So we had to shelve that product. But there is no upfront, unfortunately, again, there is no upfront push by the government. In some other countries, governments do a lot of support in terms of credit guarantees and capacities to trade credit insurance for domestic market capacity building, especially in these times. But unfortunately, in India, it's not there. And unfortunately, in India, with the foreign players reinsuring it, they would like to see the minimum threshold, which is not really in line with the SMEs segment in India.
One question from the YouTube right now, from Pavan Kumar Mittal. Whether do they have to inform about the credit limits that they currently have on specific buyers to the insurance companies in case if they offer credit insurance?
Yeah, so how it works is that you necessarily have to inform some kind of a limit. So when you buy trade credit insurance, when you give buyer details to the insurance companies, the buyer detail consists of name, addresses, registered address, and the limit request. So if you can have the exact limit what you already enjoying, you can ask for the same limits to be reconfirmed by reinsurance companies, insurance companies, sorry, or you can ask for expected limits. So right now, if you're selling up to, let's say, 1 crore per month to a specific buyer, but there is an order worth 2 crores, and you want to have the insurance company's opinion, you can straight away apply for limit of 2 crores. If the insurance company give, you can start. But you have to necessarily mention a limit request. That can be your existing or your expected sales or exposure at any point in time with that particular buyer. But necessarily a limit has to be mentioned.
There's a question by Ketan Gaikwad. If the buyer knows and the buyer is willing to share the information, okay, about their payment history and their digital footprint, will it not actually help the insurance company take an informed decision? Will it not be a welcome step?
Yes, definitely. If the the information need not necessarily come from buyer's side directly. So the buyer has the same information which the seller has. If the seller asks for financial information from the buyer and the buyer gives financial information to the seller, which seller in turn pass on to the insurance company, that's a perfect scenario. But the call definitely is the seller. So there is no prohibition in the policy which says if you make the buyer available, the cover is ceased or ceased to exist or cover gets cancelled. There's nothing of such sort. So you can always inform the buyer if you think that that's the best practices, that's best for buyer and seller, you can always do that. But where I'm coming from is the past experience in the market. It can be different in the specific buyer-seller relationship.
Uh, who are the players in the market offering, a credit insurance policy for domestic sales?
The players are New India, HDFC Ergo, you have ICICI, Tata AIG, you have Future Generali. These are the companies who are offering trade credit insurance in the market.
Is there insurance available on Iran?
Iran, there can be ECGC structures available, but private sectors, there is no cover available on Iran right now through private sector.
That brings us more or less to the end of all the questions. We've got one more if you're comfortable answering that.
Absolutely. Why not?
Is it possible to take a policy, a policy from two different companies for different customers, that is domestic and export?
So you can have a export policy separately from one insurer, and you can have a domestic policy separately from another insurer. But once you have one sort of policy, once you have, let's say, a domestic policy where underwriter can cover you for export as well, then it is not allowed to show partial export turnover in the domestic policy and then partial export turnover in the other policy. Usually, with one underwriter, you should give the entire book, but you can have possible selection between an underwriter who can do export. For example, you can take state-owned company like ECGC to cover all your exports, and then you can have a private sector underwriter to cover all your domestic. But once you have covered your sales through ECGC, you cannot take out the buyer and then give it to the private sector for the inclusion. That's not allowed.
Okay. Another question from the YouTube, from Pavan Kumar Mittal. He wants to know whether they would have to fix the credit limits to take an insurance. So can you elaborate actually how the limits?
Right. So limits, once I'll start with once again with the trade insurance policy start point. When you buy the insurance, you have to give all your buyers details to insurance company. What insurance company does is, basically they will start afresh. They will start from zero. So whatever you have done in the past, that will definitely be captured in some kind of a forms with the insurance company. But to begin with, the insurance company will source market information from third-party sources, and then they would run their own analysis on the sector and the specific market information or publicly available information on that specific buyer. And then based on your recommendation and your track record of past loss ratios, how you have managed your receivable in the past, they will give you the limits. So these are some kind of a fundamental and subjective calls taken by insurance companies to give limits. But this exercise is done for each and every buyer, independently of what you have done already on that particular buyer.
That brings us more or less to the close of all questions.
Thank you very much, everybody, for joining us. I hope Suresh has been effective in conveying his point of view and explaining and answering your questions. Please feel free to write to us if you still have any other questions, and we'll be more than happy to answer them offline. We are more than happy also to do a one-to-one with somebody who is very keen to, go ahead with the product. So your feedback and your questions are welcome. You have the email IDs being displayed right now. So thank you very much for being there, and we will keep you updated about our next webinar series, and looking forward to seeing you again. Thank you.
Thank you very much, all. I appreciate your time. Thank you.
Stay safe.
Stay safe.
Stay home.
Yes. Thank you. Bye-bye.
Thank you.